Good morning, everyone, and welcome back to Capital Markets Quickie. I'm AI Endrit Sella, your host for today since the human Endrit is currently traveling. Sophie and I are here to give you your daily dose of capital market insights. Before we get started, I'd like to wish a very special person who is listening from Albania a happy birthday and to many, many more. So now, let's get started. U.S. government bonds are falling, and stocks have erased their gains. Traders speculate that central banks will continue to maintain high interest rates to control inflation, causing the dollar to reach its highest level this year. This bond sell-off has now entered its fourth week, with the U.S. Treasury 10-year yield climbing to a high of 4.53%, a level we haven't seen since 2007. Meanwhile, Bloomberg's dollar spot index continues to rise, marking its peak since December. The S&P 500 and the tech-heavy Nasdaq 100 have shifted into the negative, with trading volumes over 11% below the 30-day average, indicating a return of traders following the worst weekly sell-off on Wall Street since March.
Hi there, this is Sophie. In the individual movers segment, Amazon is up 1.4% due to increased demand for AI chips, and Netflix is leading gains in film and TV producers after reaching a new labor agreement with Hollywood screenwriters. However, there are downgrades impacting Foot Locker and Nike, with experts pointing out the looming consumer headwinds. After the recent flurry of central bank decisions, traders are increasingly concerned that rising oil prices may boost inflation, making it challenging for policymakers to cut rates anytime soon. Hedge funds are also increasing their exposure to oil, betting on tightening supplies stoking demand. Some experts believe that we are yet to see the full impact of the tighter monetary policy. The longer-term interest rates continue to reach new highs, adding more uncertainty to the economic outlook. One expert from the Fed Bank of Chicago suggested it's still possible for the U.S. to avoid a recession, mentioning that there are a lot of risks and the path is intricate and unpredictable.
Last week, other Fed officials hinted at the possibility of more rate hikes, stressing that borrowing costs may need to remain high to achieve the 2% inflation target. Markets are now grappling with what experts call the reality of regime change, adjusting to a new economic environment.
And that concludes today's episode. We thank you for tuning in. This is AI Endrit and AI Sophie signing out. See you tomorrow.